3-minute trader tip, 2 key challenges with trail stops. Let's just revise what we're trying to achieve with a trail stop. Quite simply, we are attempting to retain as much profit as possible in a position that goes in our desired direction, so managing profit risk. Additionally, of course, if we trail right from entering a position, we can reduce initial risk through a trail stop. And of course, we can use trail stops in a combination with accumulation approaches, as we've talked about in other videos. The key question is, how is what you're doing serving you now with your trading and your trading results? So let's take a step back and look at the challenges that you face when looking at trail stop. And our first one is to decide which approach we're going to use. And there are 4 choices in our overall approach. First of all, of course, we don't have one, and we just rely on an initial stop and profit target, or informally, when you feel like it, just use the force or some other supernatural power. Evidence shows that this possibly isn't the right way to go. Secondly, we use a price-orientated indicator as an indirect trail. So, for example, the MACD signal line crossing the histogram with or without a safety net, such as the 20 EMA. We've talked about this in another video, but that's another alternative to trailing a stop, even if it isn't actually placing a trail stop on the system, but simply checking in on whatever indicator it is you're using, perhaps at the end of every candle close. The third choice is to use a passive trail. And what I mean by this is we potentially have one trail point. So the way we set that up is we have a stop, we have a profit target, and then once price hits a specific point, we would trail up to break even to make sure that we don't have a losing position at any time. So our worst scenario is break even. And our fourth, and probably the more common and anecdotally the more profitable, is to use a system or manual regular movement in your trail stop, often at the end of each candle or specified price action. So let's say it's the latter, then we've got a decision to make. Our number 2 challenge is which strategy are we going to use. So common strategies are a price crossing the EMA, so for example a 20 EMA. So every candle will trail up the stop according to where the 20 EMA actually is. Secondly, we can use a retracement approach. So every time a price retraces and subsequently continues in that original trend, we can trail the stop up to the base of that retracement. The third is we use levels. So we use key levels on smaller time frames, or more commonly something like a multiple of an ATR or multiple of your initial risk. And of course, this may be automated on your platform if you're using MT4 or MT5. Which means you continue to trail even if you're not watching the market, which obviously has advantages when you're perhaps sleeping, for an example, overnight. So those are the 3 common strategies. But of course, whichever you choose, you need to be absolutely specific and unambiguous in your trading plan statements to make sure that you're consistent in action and are able to measure this. Now, which you choose may be dependent on a few things. First of all, the ease of use. Certainly a price EMA is very easy to use even for beginner traders. If you're starting to use something like levels, then that requires a little more time for calculations and monitoring. And of course, subsequently, once we put a system in place and traded it religiously, we can start to gather evidence on what's working best for you. So those are the 2 challenges. Your challenge now is to plant your flag in whichever's going to work for you. Trade safe, and we'll see you again soon. Bye-bye for now.